today on the Land and Everything Else podcast, I am being joined by Jeremy Heer with the University of Illinois Foundation. As a University of Illinois professor myself, I'm very grateful for the work that they do, both for me and for my students. But Jeremy, I'm really excited to get to have you today, and I really would like you to just kind of give us a little bit of background about who you are and how did you get here?
Well, I'm a proud University of Illinois alum at
Love
Illini.
that. Go Illini.
I graduated in 1993, and I moved to New York to go make $1 million in the stock market, and I did, but it took me about 20 years to do that. So, it's a little harder than it looks. I held a variety of jobs in New York. I started out as a stockbroker, which back in 1993 was more like a telemarketing job. Mm-hmm. And you've seen the movies. Well, I saw a lot of that too, Wall Street kind of stuff. I only did that for about 6 weeks, and then I decided I needed to do something better. I went and traded commodities for about 3 years, including a year on the floor trading coffee.
It's very cool.
And then, thanks, it was,
growing up on a farm, I'm very familiar with trading just corn, soybeans, wheat, those types of things, but coffee's a little bit different.
Well, off the floor, I traded all of it, so
yeah.
I kind of get it. And then I went to Morgan Stanley and started out in their derivative operations group in Brooklyn, kind of, in a deep, dark back office doing reconciliations, and worked my way up. Got some recommendations and went to NYU, got my master's there, my MBA, and I doubled in finance and statistics. I learned to code in there and got a job doing kind of middle office risk management, like a database jockey kind of thing. That was a fascinating group. It came about because of long-term capital management. When they blew up, people around Morgan Stanley said, well, what's our exposure to these guys? Like, oh. So our job was to figure that stuff out.
Yeah.
And did the CFA program and decided that maybe investment management's where I wanted to be. So I started following Morgan Stanley Investment Management's job board, and they were looking for an analyst that could write code.
That's you.
That was me. And so they moved me into their global asset allocation team in early 2003. I was there for about a year. I loved it. I worked under an absolute titan from the industry, a guy named Barton Biggs, who was just an absolute force of nature. I'm sad I didn't get to work with him longer. I ended up moving to Chicago because my dad got sick. He got Alzheimer's, and I wanted to be closer to him. And so I had a friend working at UBS, and he said, hey, you're an asset allocation analyst. We're looking for an asset allocation analyst in Chicago. I talked to them. They moved me here in April of 2004. This was the former Brinson Partners team. We were managing, I think at the peak, $220 billion in global balanced mandates. I was part of a big global team, and it was a fantastic experience. I really enjoyed it. Large commercial scale, giant mandates from, sovereign wealth funds and that kind of thing. After that, those things never last. And so the guy that ran the division left and started a hedge fund, and he went around and got a bunch of really smart people from UBS to go with him. And then he came to me. Yeah, pretty much.
Yeah.
Yeah. And I went with him, and I helped launch his fund, and that was a wonderful experience. And I learned a lot about, what to do and what not to do when you're doing something like that. After about a year of that, I got a call from the University of Chicago. They were creating this new strategy team to do total portfolio management, top-down asset allocation, beta management, those sorts of things. And they'd hired this woman, Quay, to run that group. And she and I'd worked for her at Morgan Stanley Investment Management. And so she's building a team. She needed someone that she knew, what they did and so on. And so I ended up being that guy, and I started there in August of 2010. And I worked at the University of Chicago for 12 and a half years, helping manage mainly their endowment pool. But I also did things for their defined benefit pensions, for their self-insurance trusts, for the hospital, all kinds of stuff. I really got around there. And I did some work underwriting private equity and venture capital deals. I did work on a portion of the hedge fund portfolio doing low beta diversifying strategies. And I've done some thematic equity investing. So I've kind of got a broad underwriting skill set, as well as like a top-down portfolio management skill set. And it's kind of a weird kind of blend of things. After a while there, the University of Illinois Foundation thing came up, and it was a chance for me to go and kind of give back. And I talked to Travis Shore, the CIO, a few days after he got hired, and we agreed that there might be something there, and I got to know the team there and made the move in early 2003. So I've been at the foundation for just about a year now. I'm managing director of investment research and engagement, and I absolutely love it. It's fantastic. We have a great team. the culture, the leadership, the ability to give back to the university, and the ability to do what I love in this place is just wonderful.
That's awesome. Man, you have a lot that I'm excited to pick your brain about.
Let's go. I'm
Okay.
ready.
So let's talk a little bit about prior to coming maybe to work at the University of Chicago, and prior more in your role as an asset allocation analyst. This podcast is geared towards alternative investments. Was there a shift in time period that you noticed in your, tenure working in this space of when people really started to become more interested in the alternative investment classes?
Well, there was big interest in the venture capital space in the late 90s,
Yeah.
right? That was, the tech bubble kind of blew that up.
Exactly.
And then, when people's portfolios started blowing up, people said, well, we need to figure a way to hedge risk out. So then hedge funds became the next big thing, right? I started to hear about the hedge fund business in kind of the late 90s. Again, remember, I've been sitting in the deepest, darkest back office of Morgan Stanley. So stuff kind of filtered down to me. It eventually got to me. But yes, that's when I started to really start hearing about hedge funds. And I also started hearing about private equity at that time. My wife was working in the equity division, and she worked with some people who were invested in Prince's Gate, which was a Morgan Stanley private equity vehicle back in the 90s. Had phenomenal returns, by the way. And I went to an annual meeting dinner with them, and I was like, wow, this is fascinating stuff. This is really interesting. There's a whole other world out there.
Yeah.
But I was more traditional. It's the stuff that I knew. I really thought at one time I thought I was going to be a trader, and then I turned out traditional asset management was where I went next. At UBS, we had a product called the multi-asset portfolio. It's a very cleverly named product. I know, right?
Hey, you know what? Simple is good.
Yeah,
Simple is good.
It
Direct
works,
right
right?
to the point.
Yeah, exactly. And so that one was a combination of our kind of global securities portfolio, which was the big traditional balanced long-only mandate that we had a ton of money in. And you combine that with some private equity and some real estate. So that was my first real, in an investment setting, my first real exposure to these things. Okay. And, again, there was a small piece of the business, and so I didn't get a lot of exposure to it, but I started to learn about, drawdown funds and the liquidity problems that happen when, they're calling for capital and you don't have it, and so on and so forth. Right. And, how do you deal with the fact that these things are valued quarterly and you get the valuations on a lag and all that sort of stuff. Right. And so that was my first real exposure to that.
Very cool.
Yeah.
If you can think back to that time, maybe what kind of excited you the most during that time period about maybe venture capital, hedge funds, land, real estate, those types of alternative investment classes?
Well, I always thought of real estate as kind of a blend between equity and bonds in a way, right?
Absolutely.
That's definitely a good way to think about it. The sort of real estate we were doing was very, core real estate, which would definitely fall into that space, right? If I think about real estate that we did at, say, University of Chicago, that was all opportunistic value add, more, more juice, more octane, more risk. Just the idea that you could, what's the one big bet you're always making? You're always making this kind of stock versus bond bet, right? In pretty much any multi-asset portfolio, if you're an RIA, if you're managing money for an individual, you're making that's the big thing you're making. How much risk are you taking? And the way you're doing it is you're doing it stocks versus bonds. But this was a chance to get some sort of different risk. You know what I mean? And as it turns out, a lot of it is pretty highly correlated.
Yeah.
So it turns out to be less of that than I thought. But at the time, that's what I was thinking is, this is a way to diversify your risk away. And it's like, well, you can't really. It's just really different ways of repackaging risk, right? And so once you get that insight, then it becomes more. Okay, well, how can I most efficiently get the risk profile that I want?
Yeah.
Right? And so then you have these tools to do that.
Yeah, matching those duration of cash flows and things like that, which obviously alternative investments vary when we look at land. You're looking at the longer term versus, maybe private equity or venture capital, maybe a little bit on the shorter term. Let's talk. So you worked through the 2008 great financial crisis. And, as someone who was a little bit younger, and I remember that time, but did not work through it. Talk to me about how maybe the mindset or the mood changed towards alternative investments during that time, during and after that time period.
Well, remember, I was working at a traditional asset manager at the time, right? And most of what we were doing was, trying to decide when we wanted to put on more risk or whether we should even cut it further. And there was definite lots of disagreement in opinions among the senior decision makers, which you would expect in a volatile environment like that, when you think you know what's going on, but you really don't. There was definitely an allure to being able to take more targeted risks and to separate, say, market risk and security selection risk, for example. We had products at UBS that did that, and they were really popular leading into the global financial crisis, because there were things you could do, like you could buy, a small cap manager, and then you hedge out small cap, risk by using Russell 2000 futures. And you buy S&P futures, and all of a sudden, boom, I've got broad market risk, but I've got small cap security selection, and that's beautiful. And then you started to think, can I do that on a broader basis across the portfolio? And that's akin to a hedge fund in a way, right? There's hedge funds that do things like that. There's others that do, the words hedge fund always kind of have bothered me for years, because it's such a broad
term for like all
right?
of the, and there's so many different types, and
Exactly.
it's all really, they're all funds, but they're all specializing in their own unique thing, and they're all, the structure of how fees are structured is all different too.
Yep. You can put them into like 100 different buckets, right? There's equity long short, there's equity long bias, there's equity market neutral, there's event driven, there's all the different credit ones, there's volatility hedge funds, and then you got macro, and you got multi-strategy, where you have no idea what you're getting a lot of the time, right? And I mean, you have some idea, but you really don't know what you're going to get from month to month or year to year in those funds. You just know that they print a nice stream of returns for a long period of time, right?
Yeah.
And so each of these is very different, and the analysis associated with them is different. The portfolio use of them is different. And so combining all of that means that it's very, very hard to think of hedge funds as a thing.
Yeah.
You know what I mean?
Well, it's so funny. And we were chatting before we started the podcast, but I'm working on my CFA too, and you finished yours, and I'm like, I got through that section in alternative investments, and I'm like, I had no idea just the breadth of what all was available in that space, and just the structure of how people are paid, and the fee structure, and different things like that. So there's a lot out there to learn when it comes to that space.
Absolutely.
Okay, so let's talk a little bit about your work at the University of Chicago. And can you tell me a little bit more about what you did there specifically?
When I first got there, I was on the strategy team, and one of the first things that we did was we built a giant Monte Carlo simulator.
Yeah, nice.
Okay.
Yes.
We were simulating the financial situation of the university.
Cool.
By varying the drivers of global capital market returns, like GDP growth, inflation, budget deficits, and things like that. So we built this thing. Basically, the output of it was what happens to the university given different levels of equity risk you took in the endowment portfolio.
Yeah.
Okay. And we had to understand the linkages between, say, when equity markets go up, people are going to be more likely to give gifts. And so the gifts number is going to go up, and that's going to mean
you create all these models to try to model those
all
types
the
of
linkages
reactions.
all had to be in there, right? And we use MATLAB to do this. And I
was about to ask, how did you do it?
It was in MATLAB.
Cool.
With Excel is kind of the source for building all the charts and the outputs and so on. And it was fascinating running through that whole project, and it took a long time, right? But we eventually came up with basically betas from 0 to 1, and then what's the terminal wealth look like? If you run it 10,000 times, like what's the median wealth? What's the distribution of that look like in 20 years? What's the probability of you hitting your restricted endowment level? Because if that happens, bad things happen. What happens if you don't keep up with inflation, and so on? The sorts of things that the investment committee cared about, right? And they're your ultimate clients. That's who you have to get comfortable with this. And so we would say, well, this is how it varies for different levels of equity risk, and then you can pick your trade-off. Because in the end, it's trade-offs, right?
Yeah.
There's no portfolio that is necessarily optimal. It's just it's completely contingent on your kind of utility function, let's say, right? And so they settled on this beta target of kind of 0.75, which was lower than our peers. We did a whole peer study, and the idea was that since we issued a lot, more debt than our peers, we needed to be a little more conservative.
I was about to ask kind of the debt structure too. So involved in the equity markets, but then also a little fixed income, things like that.
Yeah, sure. And I mean, any endowment's going to have a decent slug of treasuries, probably.
Yeah.
Right, because that's your risk-reducing asset. It's going to be your money good when things go bad, and so therefore you can use that to make payments to rebalance out of when when risky assets get beaten up. You don't ever want to be a forced seller of those assets.
Yeah.
And so you still need to make your 5% payout, which is pretty standard across most endowments. They're kind of 5-ish%. So in order to make that, you're normally going to liquidate treasuries or something like that, right? And so you're always going to have a slug of fixed income. All right. Now, if you want to start talking about other types of fixed income, then it gets more interesting because the endowment and foundation world tends to not hold a lot of that kind of stuff. You say investment grade credit, for example.
Yeah.
Credit's kind of seen as kind of a wrong way asymmetric bet, right? The best thing that happens is you get your money back. The worst thing that happens is it goes to zero, right? And that's a problem. Swenson wrote about it in Pioneering Portfolio Management. I don't know if you've had the chance to read that book yet. I would highly recommend it. If you want to know about how a lot of the people in this space think, that's a great place to start. The other problems with credit is that it gets illiquid right when you need the money, right? And oftentimes you only have days to redeploy. And so you've really got to have that money fast, right?
Yeah.
And the other thing is that it's going to underperform when you're versus treasuries when you're going to rebalance, right? So why would you lock in that underperformance when you can just have had treasuries in the first place and be happier?
Yeah. Well, and after the financial crisis, everybody's mindset towards credit shifted quite a bit, and obviously there should a lot more regulation and things like that, as there should be.
Yeah, and we can talk about credit rating agencies and that if you want. But so that was the first project I did. All right, and then I did similar projects for the university's self-insurance trusts. They self-insure against malpractice at the hospital.
Yeah, with being such a big medical school.
Exactly. And so I did, and then I got to get comfortable with actuarial reports and things like that. That was really fascinating to understand the liability stream. And then I did a similar thing for the hospital itself. And for that one, it was all about keeping your credit rating. And so we would look at financial measures that, the credit rating agencies used and compare those to peer sets and things like that.
Cool.
That was pretty great. I learned a ton during this time period.
Yeah.
Toward the end of this, toward the end of that medical center project, we also started looking at low beta diversifying hedge funds. We called it global macro, but what it really was we were trying to find something that was going to earn more than zero, which was what cash was earning, right?
Yeah.
And we couldn't load up any more equity risk. And so you want to buy stuff that's going to have low equity risk.
Yeah.
And for that, it was going to be, macro funds, maybe some multi-strategy funds that were, low beta. We looked at a whole bunch of different things. We looked at CTAs and things like that.
Is there a certain sector that you're focused on in those macro funds or area?
No, global macro. You generally preferred, the broader opportunity set, the better. Yeah. There was at least one manager that we hired that was an emerging markets macro manager, and they just kind of specialized in that, had better information flow and so on.
Yeah.
And the swings in those tend to be bigger. You can get a bigger edge if you get it right. And so but we built a portfolio of those over time. There were some organizational changes that happened while I was doing this, and I got shifted into the private equity team for a while.
Okay.
And that was a really fascinating experience because I had very little private equity experience except what I had witnessed while I was there.
Yeah.
And I spent a year on that team underwriting private equity and venture capital deals, both, in terms of re-ups, managers we already had, but also new underwritings, which was really interesting. And I think I put on 100,000 air miles.
I bet. Yeah. What was maybe, if you can, what was maybe one of the most interesting deals you got to work on?
Well, I'm going to pick a couple of them.
Okay. Yeah, great.
Okay, good. So there was one deal I worked on. It was a first-time fund. They did enterprise software. So, and they had a very interesting thesis around basically moving from kind of, local data centers to the cloud meant you were going to have a whole bunch of different companies that were going to do things like cybersecurity and storage and so on. And so those sorts of companies were going to need venture capital investment.
Yeah.
Right? It was a small fund, and we were a decent sized chunk of that fund. Worked out pretty well. I think we did the next two funds there. I don't think he's raised a fourth yet. That was one of my favorite ones to work on as far as a new underwriting.
Well, especially with the rise of, we're more interconnected than we ever have been. That was probably a very good choice on your part, investing in that cybersecurity space, because that's continuing to grow.
Yeah, we were super early, and it's taken a while for his thesis to play out, actually, longer than we thought. But but it is playing out. We worked on another very interesting buyout fund that they just did a bunch of, so buyout, right? So corporate finance deals. They're doing M&A, and they're buying companies and helping them get better at what they do and then selling them. This one did some really interesting, just very small, niche-y, hairy deals. And so it took a while to get comfortable with that as well.
Like a lot of small firms.
Yeah, small firms. Yeah. Like I remember one of the companies was they manufactured paint for tennis courts. right? It's amazing what you remember,
That's
right?
awesome.
Now remember, we're talking. This is 10 years ago, right? So
Yeah.
I'm kind of drawing on fuzzy memories, but yeah, paint for tennis courts, and that was one of their best investments. I remember that one very well.
That's hilarious. That's so random.
Right.
That's not what I would have expected, because it's not what we refer to as like sexy in the investing world.
Well, we talk about, everyone gets excited about public stocks and all that, and there's whatever there's whatever, call it 4,000 of those in the United States, give or take, right? I think there's the Small Business Administration says there's 33,000 small businesses in this country.
Yeah.
All right. And so those businesses, there's just a ton of opportunity out there.
Yeah. I teach a small
Just
business
ton.
finance class at Illinois, and my students, I tell them, I'm like, you need to know this, because even if you're going to go at some point, you're probably either going to own your own small business, or you're going to work for a small business, or you're going to have dealings with a small business, because most people don't realize, the U.S. economy is so dependent upon those businesses.
That's right. They don't. They all think it's all NVIDIA and Microsoft. And
yes.
whatever the Mag 7.
Yeah,
right?
Whatever's in now in Bloomberg or whatever.
Sure.
So,
yeah. So
cool.
So that was pretty neat. I really enjoyed that. But then after a year, we had another organizational change, and I went back and did strategy some more. And I stayed in the strategy team until I left the University of Chicago. Okay. Along the way, we did multiple asset allocation studies. We gradually increased our kind of risk tolerance. The committee changed over a little bit, and the global financial crisis faded a little bit, and so they kind of got said, hey, maybe we can take a little more beta. They convened this committee that figured all this stuff out. It was really, they were really very thoughtful.
I was curious kind of where your guidelines came from, your regulations on that.
Yeah. Okay. So any endowment or foundation is going to have a board of directors or a board of trustees that governs it, and they'll usually have an investment committee. It'll go under different names, like or the investment policy committee, but you get the idea.
Yeah.
The investment committee at the University of Chicago was made up of a bunch of very, very smart people who all, were just very, it was a very impressive group.
I could see that.
Yeah. And so they were very hands-on, and they really, had a plan and really stuck to it. And
especially if you're like an alumni or something, you kind of have that strong connectional tie to
That's
it
right. too. That's right. Yeah.
Which brings us to, let's talk about your current job.
Sure.
At the Illinois Foundation. I know you haven't been there too long, but I was reading your annual report in preparation for this, and I saw last year that you guys returned 9% in an endowment portfolio. It's very impressive. Can you talk to me a little about the structure of the endowment portfolio at the University of Illinois?
Sure. Our basic asset allocation model is bottom-up driven. Okay. So rather than, and this is very interesting for me, because as I told you, most of my career has been around, investment management's been around top-down asset allocation, right? We're bottom-up driven. So instead of looking at a manager and saying, well, this is a private equity manager, and here's our private equity bucket, and here's how much we need to put in that bucket, right?
Yeah.
Instead, we look through to their underlying holdings, individual line items, and we map those to what we call beta factors. Okay. And it's not a regression, it's not a quant thing. It's just, you can just think of it as dollars. Okay. And so the 6 beta factors we use are equity, rates, cash, credit, commodities, and real estate. Okay. Some securities could be more than one of those things. An oil stock could be half commodity, half equity. But we're going to map them very, very simply. It's a very blunt instrument, okay? We just want to have a broad idea of what we've got, all right? So you sum all that up at the individual security line item level, and that's your asset allocation, okay? Which frees you from having to say, oh, I'm going to have 30% in public equity and 27% in private equity. And, whatever. It kind of frees you from that, right? So that's really interesting.
Yeah.
We manage overall illiquidity at the total portfolio level. So we look at things like unfunded commitments as a percentage of our net asset value. We look at the overall total amount of locked up capital. We look at how much we can get back in a year and how much we can get back in 3 years and so on. We do stress testing and things like that. And so we make sure that we are not out over our skis. Because once you get out over your skis, and if you have too much in privates and you have too much committed, then the market's turned down, and then all of a sudden you have trouble making your payout, or you have to sell something that you really don't want to sell because it's gone down a lot.
Yes.
Right. Being a forced seller is always something you want to avoid.
Absolutely. Okay. No. And when we look at what are some of the goals, initiatives of the endowment portfolio, other than just maybe generating good returns? That's the main one. That's the goal, right? And so we can talk about what good returns means. Yes.
Okay. So
let's do that.
Every endowment is going to have a basic goal of achieving something we talk about as intergenerational equity. Okay. Which means that it's supposed to benefit every cohort equally from now through the end of time.
Okay.
Okay.
All right.
And the agreed upon metric for that is that you never want to let your endowment go down in real terms.
Mm-hmm.
And since you have a 5% payout, right?
Yep.
5% plus inflation is going to be a target of your
Yeah.
program. It always is, right?
Yep.
Okay. And so that's the way we kind of, evaluate the overall program.
Yep.
Now the investment office, we specifically get evaluated based on a 70-30 public benchmark.
Okay.
Okay. Yeah. And so
Makes
70% MSCI All Country World Index, 30% Bloomberg US Aggregate Bond.
Gotcha.
Okay.
Makes sense.
And so, that's what we're trying to beat.
Mhm.
And we try to beat that by, just getting better opportunities than what's in that index.
Mhm.
And that can come from, not exactly mimicking its sectoral composition. It can come from not exactly mimicking, its market exposures, whatever it takes. But really what we think we do is we find the best businesses and own them, hopefully for long periods of time, and let them compound.
Yeah.
And hopefully do that through, advantageous structures.
Yes.
Okay.
Mm-hmm.
And so,
Talk to me a little more maybe about those structures.
Well, it depends on the instrument, right?
Mm-hmm.
We tend to do things, we tend to own a lot of equities generally. That's going to be your biggest piece. Obviously, that benchmark 70% equity.
Mm-hmm.
Our asset allocation targets are something like 62.5 equity and 12.5 rates, and 5 real estate, 5 commodities, and 15 credit. And if you mapped the benchmark to those using our methodology, it would get pretty darn close to those targets, right?
Yeah.
So equity is the biggest piece of it.
Yeah.
And it isn't always going to be public equities. We think a lot of the we'll call it alpha for lack of a better term.
Okay.
Right? A lot of the alpha out there is in the private markets, right?
Yeah, it's true.
They're less liquid, they're opaque, there's ways to get informational advantages. And so we go out and we try to find the best partners for that. We're trying to do it in a concentrated format, okay? So we're trying to have a concentrated portfolio of concentrated investments. Therefore, everything's high conviction, everything's rowing in the right direction.
Yeah.
That's kind of the broad approach.
No, that makes sense.
Okay.
When you look at your approach, because this is the land and everything else podcast, so I
Of
have to talk
course.
about real estate
We can talk about that.
specifically. What is your approach to real estate for the endowment fund?
Real estate is a tough one.
Yeah.
Okay. And I say that because real estate funds, so there's how do you get exposure to real estate, right? There's a few ways. You can go out and you can buy REITs.
Yep.
We think of something like maybe S&P Home Builders as having some real estate exposure as well, right? That's another way to get it. But you can also do it through private funds. And private funds are fascinating.
Yeah.
And there's a ton of alpha opportunity there. But the fee structures are very, very difficult to get past, in my opinion.
I can see that.
Okay. Because most real estate funds that I've seen tend to have multiple levels of fees.
Yep.
Right, because you have somebody who's the asset manager
Well, you have
that
the
raised
management
the funds,
fee and
then
general partner fee, like all of those things.
and they all have somebody else to actually manage the properties, right?
Yep.
So then and not only will they get paid in management fees, but there'll usually be a promote.
Yep.
Right, and so all of a sudden you end up with, carry for this guy and carry for this guy and carry for that guy and fees for these people.
Too many people
And
taking
where am
slices
I?
out of the pie.
Where do I get that?
Yeah.
Right? Where do I get? And so it's really hard for us to underwrite a real estate investment on the private side. We do look at the REIT market, and when you evaluate REITs, you need to evaluate them not only by themselves. Look at, say, their price to funds from operations, versus history. But you also need to look at it relative to the other things we can do, because every dollar in our portfolio competes against every other dollar. And so you want to look at things like where are the dividend yields on these things versus fixed income alternatives? Where are they versus or versus equity opportunities, right?
Yeah.
In the rest of the market.
Yep.
And so, like, we recently did an analysis and we found that they actually look kind of interesting versus other equities, but not against fixed income, right? Because yields are okay, but fixed income's up higher, and so why am I going to take the risk, right?
Yeah, exactly.
Yeah. And also, historical analysis of a REIT index is fraught with peril because the sectoral changes are massive.
Yes.
Right. I think we figured out that the NAREIT index, for example, is 20%, over 20% in data centers and telecoms, and it was basically zero, say, around the GFC. Right?
Okay.
Yeah. So those sorts of changes, make valuation comparisons over time very difficult to do, right?
Yeah.
If you're going to do it versus times in the past.
Yeah.
So, In general, we haven't found a lot that we really love in
Okay.
real estate, but we are open-minded and
Uh-huh.
always looking. And
Yeah.
if I can find something that gets past these things,
No, I can understand that.
yeah,
Yeah, it's hard in the REIT space, especially when, I work in the farmland space and I work for a fund that invests in farmland. And it's interesting when you look at these REITs, they don't always track the actual, because of all the fees and things that are coming off.
Yeah.
They don't always track the true real estate market.
That's
We've
right.
seen farmland appreciate 20, 30, 40% in areas over the last 3 to 4 years. But when you look at some of the large public farmland REITs, they're not necessarily tracking that way either. So,
and we do have some farmland in our portfolio.
that was my next question.
Yeah, we've had people gift us farms, and so we keep them, and we have someone that manages them, and they've done pretty well actually.
That's great. Do you guys have managers in house, or do you outside?
Outsourced. Yeah.
That's what I figured.
Yeah, we're not.
You're not driving around to all the farms in Illinois.
if you can show me if the way I can do that's going to compete with doing the same thing, looking at say venture capital or private equity deals, then hey, I'm on board. I have no problem with Central and Southern Illinois or Iowa or any of these places, right? I mean, I grew up in Peoria.
We're both from Central Illinois. So.
That's right. Yeah. I've driven past a lot of farmland in my day.
I know. Well, I was telling when we were talking earlier, and my family farm just like south of it, about 10 to 15 miles, there's a big University of Illinois sign right where if somebody had left a property to the university for the research purposes, also for the endowment purposes and things like that. So it's pretty cool when you drive around and you see those signs all across the state.
Yeah, it's beautiful.
Yeah, it is.
I'm a big fan.
Yeah. Let's talk a little bit, move away from land and talk about digital assets. Any exposure in the portfolio in digital assets?
No explicit exposure.
Okay.
Right. I mean, we have some venture managers that dabble in the fintech space, and they might be doing something in that. I don't think we actually have any right now.
I was just curious.
Yeah, we did do when I was at U Chicago. We did a few of like managers that did that kind of stuff.
Yeah.
Right? No direct holdings. Now, personally, I can tell you that I've experimented in this space a bit more than most. But, seriously, I got interested in the space back in 2017 or so.
Okay.
And one of my colleagues at the University of Chicago at the time, he actually left and started a crypto hedge fund.
Wow.
Yeah. So he was
probably doing okay right now.
Pounding the table in the space. Yeah, and he's one of the smartest people I've ever met.
Yeah.
And just really, really, he was very passionate about it. And so I started, I bought a small portfolio of, Bitcoin, Ethereum, Litecoin, and Ripple.
The big things.
I built a mining rig with my son, and we mined Ethereum for a bit.
How was your power bill?
It wasn't bad.
Okay.
Really, and we made, I calculated we ended up shutting it down because my GPUs all burned out.
Oh, okay.
And I didn't feel like replacing them.
Yeah.
And so, I think we did pretty well on a net basis if you netted it all out, including power, which I kept track of.
What a cool father-son project. Some fathers and sons, they build, things in the backyard or woodworking projects, but that's pretty funny.
It was pretty great. And, we learned a lot about, setting up something like that and speccing out the budget and all that, acquiring the materials you need, putting it all together, figuring out how to make it go. And when you do something like that, you end up, becoming part of a pool. And so you get your fractional share based on compute time and all that. And so we did pretty well, I thought.
That's cool.
And during COVID, I experimented a lot more with yield farming and things like that. So I have a pretty good idea of I think of what works and what doesn't work in that space. But this is all personal account stuff, and it's never been more than a small portion of my own my net worth because you just don't know, right? It could all end up being zero in 5 years. I have no idea.
Especially when we're still uncertain about regulation, and we have been for so long. We don't know how that could change over the next 5 to 10 years, and that's ultimately would affect the returns in that space.
That's right, and it could be tremendous, right? Although I will tell you, I bought my first Bitcoin when it was at 2,000.
Oh gosh.
I didn't buy enough though.
No, you didn't. It is funny. I had a friend in college who bought Bitcoin and sold out of it so he could buy a pizza. And now I think he's probably regretting that decision.
Yeah, I think it's definitely appreciated a bit relative to pizza.
Yeah, I would say so.
Although the pizza price has gone up a bit too.
It has, well,
to be fair.
Yeah, inflation it's hitting everyone. Pizza too.
Exactly.
Well, just kind of wrapping up here. I could talk all day about all of this. I think this is awesome.
I can too.
But let's talk. We have a question that we always ask all of our guests. It's not scary, I promise. But if you were, talking with an investment advisor, or financial advisor, I should say, and who has a client that is interested in the alts space, where would you direct that advisor maybe to how to educate their client, or maybe where to seek out materials on education on this space?
Um, for general education, I'm a
Hmm.
big advocate of both the CFA Institute
Yeah.
and the Kaya Association. I have
Okay.
both designations. I do work for both of those organizations, and I think that they're both not only very well informed, but they
Hmm.
also actually have the best interests of that
The
client
client
at
in
heart. And so I think that's a good place to start.
Yeah.
Um, I really, I would beg that person to do their homework
Yeah.
and to really make sure they understand the legal structures around these
Hmm.
things, because that's just an absolute crusher.
Yeah.
It can destroy your entire return profile if you don't get it right.
Yeah.
Okay, in terms of the fee structure, the incentive structure,
Yeah.
right?
Tax structure.
Right. Yeah.
Like all of
Taxes.
it. Yeah.
The tax part. I mean,
Yeah.
a good advisor understands that part
Hmm.
anyway, the tax part. But a lot of alternatives, right? The tax part is, first of all, for on the real estate side,
Hmm.
incredibly accretive to
Oh.
a retail client, or
Hmm.
to an individual taxable client,
Hmm.
right? A lot of the natural resource stuff,
Yeah.
energy plays,
Energy.
for
Oh,
example,
yeah.
right? You have all
Yeah.
the accelerated depreciation things and all that.
Yeah.
You can absolutely help a client a ton with that kind of stuff, but you've got to do your homework. You've got to make sure you understand all that. Make sure you have a good
Hmm.
make sure you have a good lawyer.
Always. You always need a good lawyer.
Yes, that's exactly right, because there's so much of it I mean, if you've ever looked at, say, a limited partner agreement,
Hmm.
these things can run hundreds of pages, and there's
Yeah.
a lot of stuff in there, and you've got to
Yeah.
understand the terms in there. And if you don't,
Yes.
you're gonna have problems.
Well, a lot of these spaces are just constantly changing. You just brought up the energy space. That's constantly evolving of what
Mm-hmm.
the next big thing is. And I'm sure, and when cryptos first came on, the scene over a decade ago, I think probably a lot of advisors had people knocking on their doors being like, tell me all about, this
Mm-hmm.
next big thing. So it is really kind of goes back to that, making sure you're educated and have a lawyer and a CPA.
Right. Well, I admit my very first exposure to this space was around 2013 or
Mhm.
14. And I asked someone about it, and they said, well, you're not a software pirate or a drug dealer, so you don't need to know. I'm
You
like,
don't,
you shouldn't
yeah.
bother. I was like, okay. So that might have been a little wrong, but
Yeah.
the point is that you really, you want to make sure you seek out advice
Mhm.
from trusted advisors and
Yes.
from people who are knowledgeable in the space.
Awesome.
And that's true across any investment. And that's public, private, alternative,
Yeah.
whatever you want to call it.
Or
right?
when your friend from college comes knocking on your door with this new great big idea that
Oh,
they
yeah.
have to start their own business.
Always do your due diligence.
Yes.
Always do your homework.
Absolutely. Awesome. Well, I really appreciate you joining me today and getting to learn a little bit more. And we appreciate all the work that you do for the foundation. And,
Thanks.
this is the Illinois Foundation is something so cool because I get to really witness the impact that it makes on my students. I was half paid with scholarships my entire college career there. And so it's very cool work that you get to do.
Thank you. I love what I do, and I think that there are very few of us that are lucky enough to get to do something
Yeah.
that they love as much as I like doing this. So,
Awesome. Well, thank you so much.
Thank you.